You are watching Daily Market Pulse. Today is Saturday, April 18th, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets face a dangerous taco dynamic as AI rallies mask collapsing consumer confidence and fiscal insolvency fears, while geopolitical de-escalation hangs by a thread. Here is the framework for today's briefing. Geopolitical de-escalation. Strait of Hormuz reopening drives oil lower, but skepticism remains. Consumer sentiment collapse. Historic 47.6 reading signals structural economic weakness. Fiscal insolvency warning. 136 to liabilities versus $6 assets spells currency debasement. Commodity time compression. Multi-year cycles now playing out in weeks due to volatility. Crypto positioning. Bitcoin as digital gold hedge versus stagflationary headwinds. Daily financial market update. Live prices, gold, silver, crypto, equities, U.S. bonds, and trend. Let's start with the geopolitical landscape and what's happening in the Middle East. The Strait of Hormuz reopened for commercial vessels following a ceasefire in Lebanon, driving oil prices down to the low 80s and reducing geopolitical risk premiums. This removes a major inflationary threat that was weighing on consumer sentiment and provides breathing room for central bank policy flexibility. Risk assets rallied as the flight to safety dynamic weakened, with Treasury yields falling to 4.24% and rate cut probabilities increasing. What to watch next? Monitor Middle East headlines for any escalation signs and oil price reactions to determine if this de-escalation is sustainable. But while geopolitics improve, the domestic consumer story is absolutely brutal. The University of Michigan Consumer Sentiment Index crashed to 47.6, the lowest reading in 74 years, driven by persistent high prices, deteriorating job market expectations, and Iran conflict fears. This isn't just a temporary dip, it's a structural collapse affecting all income levels, signaling an imminent slowdown in consumer spending, which drives 70% of the economy. Despite this data, equity markets continue rallying due to AI investment and wealthy asset holders driving the wealth effect, creating a dangerous divergence. What to watch next? Watch retail sales data, credit card delinquencies, and any signs of tightening credit standards as leading indicators of recession. The consumer weakness connects directly to our next issue, the government's own financial crisis. Economist Steve Hanke highlighted that the U.S. Treasury is technically insolvent with $136 trillion in liabilities against just $6.1 trillion in assets, while M2 money supply grows at 6.7% annually. This structural insolvency forces the government to rely on the inflation tax, devaluing currency to service debt, which directly impacts consumer purchasing power. This supports the case for hard assets like gold and Bitcoin as hedges against fiscal debasement, though short-term volatility remains high. What to watch next? Monitor M2 growth rates, Treasury auction demand, and any signs of foreign central banks reducing U.S. debt holdings. This monetary instability is creating unprecedented speed in commodity markets. Commodity analyst Wagner identified a compression of time where multi-year price cycles are now unfolding in weeks, with gold targeting 5,400 and silver showing 162% gains. This acceleration reflects geopolitical instability and monetary uncertainty, creating new trading dynamics that favor rapid response systems over traditional approaches. Gold has broken below 4,900 resistance with little overhead resistance, while silver significantly outperforms, signaling strong risk-on sentiment within precious metals. What to watch next? Watch for breakouts above key resistance levels and rapid mean reversion events that could trigger broader commodity momentum. All of this sets up a critical decision point for Bitcoin and crypto positioning. Bitcoin is positioned as a critical hedge against fiscal insolvency and fiat debasement, likely correlating with gold's rally as a digital gold asset amid the current monetary instability. As fiscal insolvency forces currency debasement, Bitcoin's fixed supply and decentralized nature make it an essential hedge, though consumer weakness creates short-term headwinds. Bitcoin faces conflicting forces: institutional adoption as an inflation hedge versus potential liquidity crunches from deteriorating consumer sentiment and risk-off flows. What to watch next? Monitor Bitcoin's correlation with gold breakouts and watch for high volatility mean reversion events driven by compressed commodity timeframes. Now let us turn to today's live market snapshot, where gold, crypto, stocks, and bonds are actually trading right now. Now for our daily financial market update. Here is where the key asset classes stand as of Saturday, April 18th, 2026. Gold is trading at $4,879.60, higher on the day, and is higher over the past 5 sessions. Silver is at $81.84, strongly higher today with a 5-day trend of plus 8.4%. In crypto, Bitcoin is at $77,111, strongly higher on the session and strongly higher over the past week. Ethereum is at $2,408, strongly higher today. Other major crypto, Solana at $88.49, BNB at $643.60, XRP at $14687. On equities, the S&P 500 at 7,126.06, strongly higher. The Nasdaq at 24,468.48, strongly higher. The Dow at 49,447.43, strongly higher. Internationally, the DAX at 24,702.24, strongly higher. The Nikkei at 58,485.90, strongly higher. The FTSE at 10,067.63, slightly higher. On the bond side, the 10-year U.S. Treasury yield is at 4.25%, lower on the session, and the 30-year yield is at 4.88%, slightly lower. Yields remain in focus as the market watches for Federal Reserve signals. Rounding out the macro picture, WTI crude at $82.59 per barrel, sharply lower. The dollar index at 98.23, slightly lower. The overall tone is risk-on. Equities and crypto are both bid, suggesting investors are positioned for continued upside in the near term. So what's the bottom line from today's data? We're seeing an unprecedented market divergence. Stock markets rally on AI investment and Middle East de-escalation hopes. But underneath, consumer sentiment has collapsed to levels worse than 2008. The U.S. Treasury faces structural insolvency, and commodity volatility is compressing multi-year cycles into weeks. Bitcoin and gold remain critical hedges against fiscal debasement, but expect extreme volatility as this taco dynamic plays out. The wealth effect from rising asset prices won't last if the consumer base completely breaks down. Thank you for your attention, and we will see you again tomorrow.